Welcome back to the Deep Dive. Today we are going to start with a question that sounds incredibly simple. Deceptively simple, really, but the more you poke at it, the more it just, unravels into a complete mess.
I like those kinds of questions.
Me too. The question is this: when have you actually sold something?
Right. It does sound like a question with a pretty obvious answer. I hand over the goods, they hand over the cash.
Shake hands.
Shake hands, deal done, revenue booked. Simple.
Exactly. If I'm at a farmer's market and I sell you an apple, it's pretty straightforward. I give you the fruit, you give me a coin. The transaction is complete. Revenue is recognized.
But we aren't talking about apples today, are we?
Not at all. We are talking about the complex, messy, multi-layered world of modern business. We're talking about bundles, subscriptions, software that gets updated over 3 years, services that are intertwined with hardware.
And that is where the whole Apple analogy just completely falls apart. In the modern economy, a sale isn't always a single moment in time.
It's more like a process.
It's often a relationship. And figuring out how to count the money from that relationship, reporting the financial truth, is arguably one of the hardest, most intellectually demanding problems in accounting.
So today, our mission is to decode the rulebook for that truth. We are diving deep into a document known as Ind AS 115, Revenue from Contracts with Customers.
It sounds technical and, well, it is. But think of it this way. This standard is the lens through which we see the health of almost every major company. It dictates the nature, the amount, the timing, and even the uncertainty of revenue.
So it's what stops companies from, say, signing a piece of paper and immediately claiming they've made millions.
Precisely. It stops them from telling investors they've made a sale when, in reality, they've just made a promise that might not be worth anything.
And we aren't just going to recite the rules today. We have a stack of specific sources here, actual illustrations and case studies from the standard itself. We're going to look at film studios, telecom giants, oil companies, and software developers to see how they have to count their pennies.
It is a fascinating journey because it really forces you to dismantle your own assumptions about what earning money actually looks like.
So let's unpack this. Before we even get to the famous 5 steps, we have to define the playing field. Who is even invited to this party? Who does this standard apply to?
Right, the scope. First things first, Ind AS 115 applies to contracts with customers. That's the key word.
A customer.
Yeah.
Sounds simple enough.
It is, mostly. A customer is a party contracting with you to obtain goods or services that are an output of your ordinary business activities.
Okay, ordinary business activities. So if I'm a car manufacturer and I sell a car, that's Ind AS 115.
Absolutely.
But if I sell my factory building because I'm moving to a new location,
That is likely not your ordinary business activity. You aren't in the business of selling factories. So that transaction would likely fall under a different standard, maybe one dealing with property, plant, and equipment.
so there are specific no-go zones,
Mm,
places where the standard explicitly says, not me.
exactly. It carves out certain areas.
And who gets excluded?
Well, lease contracts are a big one. Those go to a different standard, Ind AS 116. Insurance contracts, they have their own world, mostly under Ind AS 117.
And financial instruments?
Oh, definitely. Things like derivatives, loans, bonds, those have their own incredibly complex rule books. This standard is for the operational side of the business, the selling of actual goods and services.
Okay, that makes sense. But I found a really interesting edge case in the notes regarding non-monetary exchanges. This is the barter economy.
Yeah.
And this seems like a place where, companies could get really creative if the rules weren't tight.
Ah, yes. The barter exception. This is crucial, especially for heavy industries. The standard draws a very, very sharp line here to prevent what we sometimes call revenue inflation.
Grossing up the numbers.
You got it. Just making your company look bigger than it is by swapping stuff back and forth.
Let's look at the example provided in the source material to really understand this. We have 2 scenarios. Scenario A involves 2 massive oil companies.
Right. So picture this. You are a global oil giant. You have a customer in Mumbai who needs crude oil now. It's urgent. But your nearest tanker is way down in Chennai, or maybe even further away. It won't get there in time.
But my competitor, another oil giant, happens to have a tanker sitting right there in the Mumbai harbor.
And what a coincidence, you have a tanker sitting near their customer in Chennai.
So we get on the phone and say, hey, let's just swap. I give their customer oil in Chennai, they give my customer oil in Mumbai. Problem solved for everyone.
Exactly. We swap inventory purely to facilitate the sale to the end customer. We don't exchange cash between us. We just swap the oil to solve a logistics problem.
Now here's the question. Did I just sell oil to my competitor? And did they sell oil to me?
What's your gut feeling?
My instinct says yes. I gave them a valuable asset, oil. They gave me an equally valuable asset, oil. Value for value. That sounds like a sale to me.
A very logical conclusion, but Ind AS 115 says no. That is explicitly excluded from the scope of the standard. Because it's a non-monetary exchange between entities in the same line of business to facilitate sales to customers, it's seen as operational. You haven't really sold the oil to the competitor, you've just rearranged your logistics in a clever way.
So why does the standard care so much about this?
Because if we both recognized revenue on that swap, we would both inflate our top-line revenue numbers without actually generating any new wealth or profit for the economy. Our revenues would go up, but our profits would be unchanged.
It would make the companies look twice as big as they actually are.
It's a wash trade. It's phantom revenue. The standard is designed to kill that.
Okay, that makes perfect sense. No phantom revenue. But now compare that to scenario B in the source, the telecom setup. Here we have A Ltd and B Ltd.
This is a great contrast. Here, A Ltd, let's say a power company, gives power units electricity to B Ltd, a telecom company.
And in exchange.
In exchange, B Ltd gives talk time minutes to A Ltd's employees.
So I give you power, you give me minutes. No cash changes hands. It's still a swap. Is this revenue?
Yes, it is, for both of them.
Okay, hold on. Why? How's that different from the oil? It feels like the same principle.
The key difference is that they are dissimilar goods. Talk time and power units are not the same thing. They are not interchangeable commodities from the same line of business.
Oh. So in the oil example, oil is oil. It's a commodity. It's fungible.
Exactly. Here, ALTD is effectively selling power to buy talk time, and BLTD is selling talk time to buy power. The transaction has what accountants call commercial substance. The economic position of both companies has genuinely changed.
So how do they put a price tag on that if no cash was swapped?
Yeah.
How do they measure the revenue?
They have to use fair value. ALTD recognizes revenue based on the fair value of the power units it gave up, and BLTD recognizes revenue based on the fair value of the talk time it gave up. It's treated as a real sale because the nature of the assets that changed hands was different.
That is a crucial distinction. Same line of business, similar goods. No revenue. Dissimilar goods. Revenue. Okay, that's the sandbox we're playing in.
Yep.
Let's step onto the actual path, the famous 5-step model. And it all starts with step 1, identifying the contract.
This sounds like the easiest one, right? Do we have a contract?
You would think so. I mean, usually we think, I have a signed piece of paper, so I have a contract.
But under Ind AS 115, a contract isn't just a document with signatures. It's a set of criteria that have to be met.
Right. The source lists them off. Approval from both parties, identifiable rights, clear payment terms, commercial substance. But there's a fifth one that acts as a gatekeeper.
And this one is a big deal. It's probable collection.
This is the new way test, as the source calls it.
It is a massive shift from older accounting. You cannot recognize a contract for accounting purposes if, at the very beginning, you don't think it's probable you'll get paid for the goods or services you're promising.
We have a perfect illustration for this. Illustration 1. New Way Ltd. This really brings it home.
Yes. So, New Way Ltd. manufactures networking products. They're an established company, but they decide to enter a new high-risk market, let's say a country that is currently experiencing a severe economic crisis.
So the currency is crashing, businesses are failing left and right. It's a mess.
A total mess. But New Way Ltd. wants a foothold there. They see long-term potential, so they find a customer and agree to sell networking products for 1,250,000 rupees. They ship the goods, they send the invoice.
And in the sales department, everyone is high-fiving. They've hit their targets. They move 1.25 million in inventory. They think they've made a sale.
They've absolutely made a sale in their minds. The goods are gone.
But the economy is tanking. The customer's ability to pay is questionable.
Exactly. At the very start of the contract, when they're assessing the deal, New Way Ltd.'s management expects that they might not be able to collect the full amount. The risk of default is incredibly high.
So they've shipped the goods. They have an invoice. Surely they booked the sale. Maybe with a provision for bad debt.
Under the old rules, maybe. But under Ind AS 115, the accountant steps in and says, stop.
Really? Stop everything.
Stop everything. Because New Way Ltd. cannot assert that collection is probable, the contract effectively does not exist for revenue recognition purposes. Not yet.
Wow. That is harsh. You've done the work. The goods are physically gone from your warehouse.
But you haven't realized the value. The standard is trying to prevent companies from inflating their top line by selling into what are essentially bad debts from day one. If you don't realistically think you'll get the money, don't tell your investors you made a sale.
It's about protecting the integrity of that top revenue number.
It's all about financial truth. This step is the bouncer at the door of the revenue club. If you don't have probable collection, you don't get in.
Okay, so step one is the bouncer. A tough one. Now, let's assume we get past the bouncer. We have a solid contract we expect to be paid. Now we move to step two, identifying performance obligations.
And this, right here, is arguably the most debated and judgment-heavy area in the entire standard. This is what I call the bundle debate.
Because companies love to bundle things, right? Buy this phone, get a free plan, buy this software, get free installation. The question is, are these one big thing or lots of little things that need to be accounted for separately?
Precisely. The standard's term for these little things is performance obligations, or POs, and we are looking for promises that are distinct.
Distinct. What does that mean in practice?
It's a two-part test. First, can the customer benefit from the good or service on its own or with other readily available resources? And second, is the promise separately identifiable from other promises in the contract?
Let's look at the source illustrations to break that down. We have a few great ones here. Let's start with example one, software customization.
Right. So an entity sells a software license, but as part of the deal, they also sell a service to significantly customize that software for the customer's specific IT infrastructure.
Okay, so I get a piece of software and a team of people to make it work with my existing systems.
Exactly. Now the question is, can the customer use the software without the customization?
Well, technically, maybe.
Yeah.
Like, they have the code.
But the source uses a keyword. The customization is significant. It deeply modifies and integrates the software. The customer didn't just want the code, they wanted a functional, integrated system. They didn't want a pile of bricks and a blueprint, they wanted a finished house.
So the software isn't really useful to them without the service. They are intertwined.
They are. The promise to deliver the software and the promise to customize it are not separately identifiable in the context of this contract. The entity is providing a significant integration service.
So is it two things or one thing?
In this case, the verdict is a single performance obligation. The software and the service are inseparable. They are one combined output. You recognize revenue as that entire integrated system is delivered.
Okay, that makes sense. Now let's compare that to illustration 17. Telco TLTD. A very different scenario.
Yes, a classic telecom example. A customer signs up for a 2-year internet plan. As part of the deal, they also buy a modem and a router from the telecom company, TLTD.
Now, I bet TLTD would love to say this is all one big internet experience package so they can smooth the revenue out over 2 years.
They might want to, but the rules say otherwise. We have to apply that two-part test for distinct. First, can the customer benefit from the modem on its own?
Well, yeah, I could take that modem, and if I canceled my plan with TLTD, I could use it with another internet provider. Or I could sell it on eBay.
Exactly. The source notes that there is a secondary market for modems. It has standalone value, it passes the first test, it's capable of being distinct.
What about the second test? Is it separately identifiable?
Yes, because using the internet service doesn't physically change or modify the modem. They don't become one integrated item. You are getting a piece of hardware and you are getting a stream of data. Two different things.
So the verdict is?
Two distinct performance obligations. Or three if you count the router separately. The equipment is distinct from the service.
And what does that mean for revenue?
It means you have to account for the sale of the modem now, at the point of sale when you hand it over, and recognize the revenue for the internet service over time, month by month, for 2 years. You can't just lump it all together.
I see. So if it's distinct, you have to split it. Let's try another one. Illustration 19, the magazine subscription.
This one is interesting. You pay for an annual subscription and you get two things. A printed copy mailed to you each month, and a login for the online portal with all the articles.
My first thought is that these are the same thing. It's just the news. I'm buying the content, whether it's on paper or on a screen.
From a reader's perspective, yes. But to an accountant following Ind AS 115, they have to be more clinical. Are they distinct?
Well, could you sell them separately?
Yes. Many publications offer a digital-only subscription, so the online access is capable of being distinct.
And does one transform the other?
No. Reading the website doesn't make the paper copy magically disappear and vice versa. They are separate deliverables.
So the verdict is two performance obligations.
Correct. You have to allocate some of the subscription fee to the print magazine and some to the online access. And this gets tricky because the way you recognize the revenue is different. The print copy is delivered at a point in time each month, but the online access is delivered continuously over the whole year.
Wow, okay. Now here's a really tricky one. Illustration 18. Antivirus software.
Ah, yes. VLTD grants a 3-year license for its antivirus software, but the contract also promises when and if available updates.
Okay, but every software company promises updates. Does that little promise count as a separate thing?
Well, let's think about the nature of antivirus software. If you don't update the virus definitions, does the software actually work?
For a few days, maybe a week, but a month later. It's completely useless against new threats. It becomes what you might call zombie software. It's on your computer, but it's brain dead.
Exactly. The utility of the software is critically dependent on those updates. The source notes that the updates are critical to the continued use of the software. The customer isn't just buying the code as it exists today. They're buying 3 years of protection.
So the license and the updates are not distinct.
In this case, it's highly likely they are viewed as a single evolving service. You wouldn't separate the license from the updates because the customer can't really derive the core benefit protection from the license without the updates. It's one performance obligation satisfied over the 3-year term.
It's fascinating how subtle the difference is between the modem and the antivirus. The modem works fine on its own. The antivirus software is essentially dead on arrival without the ongoing service.
Context is everything. You have to ask, does one item fundamentally depend on the other to function as promised to the customer?
Before we leave step 2, there are 2 more curveballs. The first is the series. The source uses illustration 13 on hotel management.
Right, this is a practical expedient to stop accounts from going insane. Imagine you have a contract to manage a hotel for a year. Every single day, you perform a variety of tasks. You clean rooms, you check people in, you do the accounting, you manage the concierge.
So is that 365 separate contracts? Or thousands of separate tasks like cleaned room 101, checked in Mr. Smith? That sounds like a nightmare.
It would be an accounting catastrophe. The standard recognizes this and allows you to group these into a series of distinct services. Even though the specific activities change day to day, some days you fix a burst pipe, some days you don't, the overall service of hotel management is substantially the same pattern of transfer to the customer each day.
So you can just treat the whole year of management as one performance obligation that you satisfy over time.
Exactly. It simplifies the bookkeeping for repetitive services like cleaning, security, or payroll processing. A very sensible rule.
Okay, one last curveball in step 2, and it's a big one. Implied promises. This is from illustration 20.
Ugh. The unwritten rule. This is where a company's actions speak louder than their contracts. So, software company K sells its products through a reseller. The written contract between K and the reseller says nothing about free technical support for the end users. It's totally silent on the matter.
I have a feeling they always provide it anyway.
You're right. Company K has a customary business practice. For years, they've always offered free phone support to anyone who buys their software, even if they bought it from a reseller. The reseller expects it, the end users expect it, it's part of their brand reputation.
But even though it's not in the ink on the paper.
It is a performance obligation. It creates what the standard calls a valid expectation. You have to estimate the cost of providing that free support, allocate a portion of the transaction price to it, and recognize it as a liability.
You can't just say, oh, that's free. It doesn't count for revenue.
Absolutely not. If the customer expects it based on your past actions, it's a promise you have to account for.
That is a huge gotcha for companies. You are financially liable for your habits, not just your written contracts.
Precisely. If you act like you're going to do something, the accountant assumes you will and makes you put a price on it.
All right, that was a beast. Let's move to step 3, determining the transaction price. This is where we figure out how much money is actually on the table.
And again, it's rarely just the sticker price you see on the invoice. We have to look at anything that could make that price go up or down. We're talking about variable consideration, discounts, rebates, penalties, and credits.
Let's start with a scenario from the source that I have to admit blew my mind a little. Illustration 52, consideration payable to a customer.
Ah, the shelving scenario. This is a classic. A large manufacturer wants to get their new product line into a big global retail chain. To sweeten the deal and get prominent shelf space, the manufacturer pays the retail chain 1.5 crore rupees.
And what do they call this payment? They call it a fee for shelving changes. Basically, here's a bunch of money to fix your shelves so my stuff fits nicely.
Right. Now, in the old days, how would a company want to classify that payment?
Oh, definitely marketing expense.
Yeah.
Or maybe selling, general and administrative. Anything to keep it away from the revenue line.
Of course, because expenses go below the revenue line. They don't hurt your precious top-line sales figure, which is what Wall Street obsesses over.
Everyone wants high revenue growth.
Exactly. But Ind AS 115 comes in and asks a very pointed question. In exchange for that 1.5 crore, did you receive a distinct good or service from the retailer?
And the source says, no. The entity does not obtain control of the shelves. They didn't buy the shelves. They can't take them home. They just paid a fee to get access.
Then it's not a purchase. The standard says it is a reduction of the transaction price. If the total contract was for 15 crore of goods and you gave the retailer 1.5 crore back as a fee, your revenue is not 15 crore. It's 13.5 crore.
Ouch. That directly hits the growth metrics everyone is watching.
It reflects the truth of the transaction. You effectively had to give the retailer a 10% discount to get them to buy your product. It was a price concession, not a marketing campaign.
What about smaller things, like discretionary credits? We have Illustration 58. A telecom company, GLTD, gives a customer a random 50 rupee credit on their bill. It wasn't in the contract, it's just a goodwill gesture because the customer complained about a dropped call.
It doesn't matter if it's in the contract or not. The moment they grant that credit, it changes the transaction price. It reduces the total revenue recognized from that customer for that period. You can't just give money away and call it a marketing cost to protect your revenue line. It's a price cut, plain and simple.
It seems like the standard is very, very aggressive about forcing companies to deduct these sweeteners from their revenue.
It is. Let's look at another one. Illustration 53. The port-in credit. This is super common in the mobile industry. Switch to our network and we'll pay your cancellation fee with your old provider.
Right, so in this case, Telco D Ltd offers a 2,000 rupee credit to a new customer to cover the penalty from their old provider. Is that a marketing cost to acquire a new customer?
It feels like it should be, right? It's a customer acquisition cost. But the standard says no. It is a payment made to the customer. Therefore, it is a reduction of the transaction price. It lowers the total revenue DLTD books from that new customer over the life of their contract.
Wow. The principle seems to be, revenue should only reflect what you actually expect to keep in your pocket.
That's a perfect way to put it. If you are giving cash back to the customer in any form, you aren't keeping it, so it can't be part of your revenue.
Now, step 3 also deals with a more complex topic. This significant financing component. This is about the time value of money.
Right. The basic idea is, if you pay me today for a product I'm going to deliver to you in 2 years, you have effectively given me a loan for 2 years. I have the use of your cash.
So you should have to recognize some interest expense, and I should recognize interest income.
In theory, yes. The transaction price needs to be adjusted for the effect of that financing. But there's a practical exception mentioned in the notes regarding prepaid phone cards.
Ah, okay. When you buy a prepaid card, you pay the company in advance. So that's a loan from the customer to the telco.
It looks like it, but the key difference is that the company doesn't know when you'll actually use the minutes. The timing of the service delivery is at the customer's discretion. You might use it all tomorrow, or you might use it over 6 months.
And the main purpose isn't financing, it's convenience.
Exactly. So Ind AS 115 says that if the timing difference is primarily for reasons other than financing like customer convenience, you don't need to calculate and adjust for interest.
That must save a lot of math for the telecom companies. Can you imagine calculating the financing component on every 100 rupee top-up card sold in the country?
It would be administrative insanity. So the standard provides a very practical relief there.
Okay, that's the price. Now let's move on to step 4, allocating the transaction price. This is the math problem. We have a bundle price, and we've identified multiple performance obligations. How do we slice the pie?
The default rule is pretty straightforward. It's the relative standalone sell and price method. If item A usually sells for $100 on its own and item B usually sells for $50 on its own, their combined standalone value is $150.
And if you sell them together in a bundle for $120, there's a $30 discount.
Right. You allocate that $30 discount proportionally. So 2/3 of the discount goes to item A and 1/3 goes to item B. Simple enough.
But of course, there are exceptions. The source lists a case A regarding products X, Y, and Z. This is where it gets interesting.
This is the specific allocation of discount rule. Imagine an entity sells a bundle of 3 products X, Y, and Z for a total price of $100,000.
Okay, but if you bought them all separately, it would cost more. There's a discount baked in.
Correct. But here's the twist. The entity has observable evidence that it always sells product X for its full standalone price of $50,000. It never discounts X. It's the premium product.
But it does regularly sell Y and Z together as a pair for a discounted price of $50,000.
Exactly. The evidence clearly shows the discount is attached to the Y and Z combo, not to X.
So in that case, you don't spread the discount proportionally.
No, you don't. If you have clear evidence that the discount belongs entirely to one or more of the items, you allocate the entire discount to just those items. Product X retains its full $50,000 of revenue recognition.
That's hugely important for timing, right? Because X might be a piece of hardware delivered today, while Y and Z are services delivered over the next year.
Absolutely. If you incorrectly allocated part of the discount to X, you'd be understating your revenue today. This method ensures accuracy. You don't want the discount on the slow-burn products to drag down the revenue of the premium product you just delivered.
What if you don't know the price of one of the items? The source mentions the residual approach.
This is a last resort, used only when a standalone selling price is highly variable or uncertain. Let's say you sell a bundle for $130,000. You know for a fact that product X has a standalone price of $50,000. You also know that Y and Z together sell for $50,000, but you also threw in a new item, product Alpha, and you have no idea what it's worth. Maybe it's a prototype or a new service.
So you can't do the proportional allocation because you're missing a key variable.
Correct. So you just do the subtraction. You take the total bundle price of $130,000, subtract the known prices of the other items, $50,000 for X, $50,000 for Y and Z, and what's left over.
$30,000.
That becomes the allocated price of product Alpha. But you have to be very careful with this. The source warns that if the result is 0 or negative, you probably have a problem. You can't allocate 0 revenue to a product that clearly has value.
There's also a quick note on variable consideration allocation, specifically license A versus license B.
This often comes up with intellectual property, like royalties. Imagine you license 2 technologies to a customer. License A is a fixed fee of $1 million. License B is a usage-based royalty. You get 3% of their sales.
And both licenses are part of one contract.
Right. The standard says that the variable part, the 3% royalty, should be allocated entirely to license B. You don't spread the risk and uncertainty of that royalty across the fixed fee license.
It keeps the uncertainty contained to the specific item that's causing it.
Exactly. It keeps the clean revenue clean and the variable revenue variable. Much more useful information for an investor.
Okay, we've done it. We've gone through the 4 toughest steps. We have identified the contract, the obligations, the price, and the allocation. Now for the payoff. Step 5, recognizing revenue. When do we actually get to pop the champagne and put the number on the income statement?
This all comes down to a single concept: transfer of control. Do you transfer control of the good or service to the customer at a single point in time, or do you transfer it over time?
And one of the biggest and most contentious concepts here is the principal versus agent distinction. This can dramatically change a company's size on paper.
It changes the revenue number massively. The question is, are you the merchant actually selling the goods, or are you just the broker arranging the sale for someone else?
Let's look at the illustrations. Illustration 26, airline tickets.
Right. An entity, let's call it a travel agency, buys tickets in bulk from an airline at a reduced rate. They agree to buy a specific number of seats on a specific flight.
And here is the key detail from the source. They have to pay for those tickets, even if they can't resell them.
That's the critical point. They have inventory risk. If the flight takes off with empty seats that they bought, they lose money.
They are on the hook. And they also set the final price for the customer.
Correct. So are they a principal or an agent?
It sounds like they are the principal. They've taken on the risk. They control the ticket before it goes to the customer.
You're absolutely right. They are the principal. So if they buy a ticket for 8,000 rupees and sell it for 10,000, how much revenue do they recognize?
They recognize the full 10,000, the gross amount.
Exactly. And the 8,000 they paid the airline is their cost of goods sold.
Now let's contrast that with illustration 27, advertising.
A very different model. Here,
Yeah.
Company D is an ad agency that places ads for its customers on video site. FD is just arranging the placement.
They don't own the ad slot inventory, right? They don't buy it in bulk and hope to resell it.
No, they are just the middleman. They facilitate the deal between the advertiser and the video site. Therefore, they are an agent.
So what does their revenue look like?
Even if the customer pays the agency 10,000 rupees, and the agency then passes 9,000 of that to the video site, the agency's revenue is only 1,000.
The net commission.
The net commission. Now think about the impact on the financial statements. The airline ticket reseller looks like a massive company with huge revenues but maybe thin margins. The ad broker looks like a much smaller company but with very high profit margins.
But if the ad broker booked the full 10,000 in revenue, they would be massively misleading investors about the actual scale of their business operations.
And that's exactly what the standard is designed to prevent.
Another critical timing issue involves intellectual property. The source gives us illustration 71, the film studio.
I love this one because it gets into the so-called magic of Hollywood accounting. So Studio C licenses a completed film to Customer D, a cinema chain, for 5 years. As part of the deal, the studio also plans to spend a fortune on marketing and advertising to boost the box office.
So the question is, does that ongoing marketing activity mean the studio is working for the customer over the whole 5 years? Should they recognize the license fee bit by bit over the 5-year period?
Or is it a point-in-time sale? The standard asks a very specific and quite brilliant question. Do the studio's ongoing activities, the marketing, change the intellectual property being licensed? Does it change the film itself?
No. The film is in the can, it's done, the actors have been paid and have gone home, the marketing doesn't add a new scene.
Does the marketing change the functionality of the film? No. It just changes the public's perception and, hopefully, the value. Therefore, the license is a right to use. The customer gets the film as it exists today, and they can show it. The studio's job, in terms of transferring the IP, is effectively done.
So they recognize the revenue immediately when they hand over the digital file.
Usually, yes. When the license period starts and the customer has access to the copy, it's revenue recognized at a point in time.
That is huge for a studio's quarterly earnings. They could book hundreds of millions in Q1 just for handing over a hard drive, even if the movie plays in theaters for years.
Now, contrast that with the antivirus software we discussed earlier. There, the ongoing work, the updates, did change the functionality of the product. The protection was an ongoing service, so that was right to access over time. This is right to use at a point in time.
Let's talk about what happens when things change midstream. We have contract liabilities and the concept of a cumulative catch-up.
The source gives a great example of a consultant. They're working on a long-term project. Halfway through the year on July 1st, they hit a major milestone ahead of schedule, and the client is so happy they give them a 20 lakh rupee bonus.
Nice. A surprise bonus. So how do you account for that?
Well, the bonus modifies the total transaction price of the contract. So how do you book it? Do you just book a big spike of 20 lakh in revenue on July 1st?
My gut says yes.
Yeah.
You got the cash, book the sale.
Your gut is logical but wrong under Ind AS 115. You have to perform what's called a cumulative catch-up adjustment.
Okay, what does that mean?
You have to look at the whole contract. You realize, oh, the total transaction price is higher now. So you recalculate how much total revenue you should have recognized in the previous months from the start of the project up to today using this new higher price.
And then you book the difference in the current period.
Yes. You adjust the cumulative revenue to date all at once. It creates a spike in the current period, that's true, but it correctly realigns the entire revenue recognition timeline. It's almost like time travel for accountants reaching back into the past to fix the numbers based on new information.
We are in the home stretch now, Section 7. Cost capitalization and disclosures. This is about the money you spend to get the contracts in the first place.
Yes, specifically incremental costs of obtaining a contract. The classic example is sales commissions. This was the bane of the old accounting world.
How so?
Under the old rules, like AS9, if you paid a sales guy a 1 crore commission in January for signing a big new client, you just expensed it. Took the full 1 crore hit to your profit immediately in that quarter.
Even if the contract was for 3 years and would generate revenue for years to come.
Yes, but Ind AS 115 completely changes that. If that 1 crore commission was paid specifically to get you a 3-year contract, Ind AS 115 says that commissions is not an expense. It is an asset. You capitalize it.
So it goes on the balance sheet, not the income statement.
Initially, yes. And then you amortize it. You expense it bit by bit over the life of the contract. So you'd expense it over the 3 years.
That makes so much more sense. It matches the expense to the revenue it helped generate.
Precisely. It stops companies from showing a huge loss in Q1 just because they signed a fantastic deal that will pay off handsomely in Q2, Q3, and Q4.
But there's a fascinating twist in illustration 74. regarding the amortization period.
Yes, this is about being realistic. Suppose you pay a commission for a 5-year contract, but you know that historically your customers in this segment are very sticky. They almost always renew for another period. The average customer life is actually 7 years, not 5.
So do you amortize the commission over the 5 years written in the contract or the 7 years you actually expect?
If the commission also compensated the salesperson for the expected renewals, you amortize it over the expected customer life of 7 years. You have to look at the substance of the relationship, not just the paper contract.
That spreads the cost out even thinner, which would boost short-term reported profits.
It does, but it also requires companies to be very honest and have solid data about their customer retention. If you claim your customers love you and stay forever, the standard makes you amortize your acquisition costs over that forever period.
Finally, a couple of quick points on presentation. The source mentions excise duty.
A specifically Indian requirement. For companies where it's applicable, you have to present revenue gross of excise duty and then show the excise duty as a separate expense. It's a presentation rule.
And what about the distinction between contract assets and receivables?
This is a crucial distinction for anyone analyzing a balance sheet. What's the difference?
I'm guessing a receivable is something you have a right to collect, no strings attached.
Exactly. A receivable means you have an unconditional right to cash. You've done the work, you sent the invoice. The only thing standing between you and the money is the passage of time. The check is in the mail.
And a contract asset.
A contract asset means you've earned some revenue because you've performed some of your obligation, but your right to the cash is still conditional on something else happening. For example, maybe you've finished milestone 1 of a project, but you can't actually invoice the client until you finish milestone 2.
So a receivable is pay me now. A contract asset is I'm halfway done, so I've earned half the money, but I can't actually bill you for it yet.
Precisely. It tells investors how much of your recognized revenue is still subject to future performance risk. A contract asset is inherently riskier than a receivable.
Okay, let's try to tie all this together. We've gone on a huge journey here, from oil swaps and telecom bundles to Hollywood accounting and sales commissions. What is the big picture, the grand takeaway from this entire deep dive?
The big picture is that revenue is no longer just the sound of a cash register ringing. It is a derived number. It is an intellectual conclusion based on a rigorous 5-step analysis of obligations, distinct promises, allocation, and probability.
And ideally, this makes financial statements more truthful and more comparable between companies.
That's the goal. It prevents a software company from booking 5 years of revenue on day 1. It prevents a telecom from hiding massive discounts as marketing expenses. It forces a company to admit that a free handset bundled with a plan isn't actually free. It's just a reallocation of the monthly fee you're paying.
So for our listener, the learner, who's trying to understand company reports, why does this matter so much?
Because when you look at a company's earnings report and you see that big, beautiful revenue line, you need to understand that it is the output of 1,000 judgment calls. If you see a massive spike in revenue, you should ask yourself, did they actually sell more stuff this quarter? Or did they just change how they allocate the price in their bundles? Did they hit a bonus that triggered a cumulative catch-up?
And if you are the one on the other side, signing the contracts with these companies, you can realize that every clause, every promise of free support, every goodwill credit you negotiate has a direct and immediate financial consequence on their books.
Absolutely. Nothing is hidden from the accountants in step 2 and step 3. Every promise has a price.
Okay, here is a final provocative thought to leave you with. We've talked a lot about how Ind AS 115 forces companies to strip away the illusion of free gifts. If a company offers you a free streaming service when you sign up for their phone plan, the accounting standard says, that isn't free, you're paying for it. We just took some money out of the phone bill bucket and put it into the streaming service bucket.
Correct. The total price is the same.
So my question for you is this. Does knowing that the world's strictest accountants do not believe in free gifts change how you view your own subscriptions and bundles? When you see that offer, are you really getting a deal? Or is it just a clever bundle of performance obligations designed to mask the true price of what you're buying?
A cynical but perhaps very accurate question.
Thanks for diving deep with us today. We'll see you on the next contract.